If you can master one skill in real estate investing, it's this: finding the right deals. Not buying properties, not fixing up houses, not even raising capital. Let me ask my investor friends, are you able to find the right deal that fits in your growing cash flowing portfolio? The truth is simple. Real estate investing is won or lost at the deal stage. A great deal makes you money, even if you make mistakes. A bad deal can destroy your cash flow, your time, and your confidence. Not only that, a bad deal will sink other properties you have in your positive cash flowing portfolio. So, if you have bought an investment home that you know is a bad deal, it will ruin your entire business. You can't be buying bad deals. That bad deal will keep eating your cash flow that's coming from other properties. So, in this video, I'm going to break down exactly how successful investors consistently find profitable deals, even in non-competitive markets, even when the inventory is low, and even when everyone else says there is nothing out there to buy. Let's get into it. Hey everyone, if you don't know me or are new to my channel, my name is Vikram Chopra. I was an investment banker turned broker in the greater Charlotte metropolitan area where I live and invest, and I help other investors realize their financial goals through real estate investing. Before we begin, it's important for you to define your investment strategy, right? Before looking at properties, decide what kind of investor you want to be. Some common strategies are buy and hold long-term rentals, that's for long-term cash flow. Fix and flip, that's for short-term profits through renovations. BRRRR strategy, that's for buy, rehab, rent, refinance, and repeat. And then we have the short-term rentals like Airbnbs or vacation rentals. And lastly, we have the multifamily investing, which are duplexes, triplexes, and apartment complexes. Everyone has different goals. For me personally, since I have a job, time is limited. If you are a lawyer, a doctor, a banker, then time is at a premium for you as well. You don't want to be doing flips or Airbnbs. A good deal for a flipper may be a terrible deal for a landlord like yourself. One example, a house needing major repairs may work for a flipper, not for someone like you and me who have a full-time job. A stable duplex with lower appreciation may work better for cash flow, and that's something that might be of interest to me and someone like yourself. Similarly, if your focus market is Miami, Orlando, then you probably don't want to go into flips. Your goal should be Airbnbs. Here in Charlotte, the best strategy is buy and hold or flips. Always remember, buy and hold makes you uber rich in the future. Understanding the market fundamentals is crucial. Great deals are often found in strong markets before everyone else notices them. Look for population growth, job growth, new businesses moving in, infrastructure development, low crime, good schools, rising rent, low vacancy rates. Austin in Texas comes to mind. Elon Musk has shifted all his operations from SpaceX to Tesla and whatever else he does. Almost everything is now in Austin. And it's not just Elon Musk. Apple, Oracle, Dell, all are moving their operations to Austin. There is a catch though. Everyone knows that the average salary working in any of these big companies is usually over $150,000 yearly. That makes real estate expensive too, because builders know that these people can afford. Section 1. What a good deal actually means. Before you find deals, you need to define what a good deal is. Most beginners get this wrong. They think a good deal is a cheap house, a distressed property, a motivated seller, but none of these guarantees profit. A real deal is one where the numbers work based on your strategy. Let's break it down. If you are a buy and hold investor, a good deal means positive cash flow, strong rent to price ratio, low maintenance or repair risk, located in a stable or growing economy. If you're a flipper, enough margin after repairs and holding costs, clear exit strategy, minimum uncertainty around the rehab scope. If you're a BRRRR investor, forced appreciation, potential strong refinance numbers, predictable rehab budgets. So the first rule is this: a deal is not good because it exists. A deal is good because it fits your math. Once you understand that, everything changes. A word of caution though, we are now in May 2026. The interest rates are through the roof. So you better be careful in calculating your holding cost. Section 2, where the best deal really come from. Most investors search in the wrong places. They refresh Zillow all day long. They compete with 20 buyers on MLS listings. They wait for hot deals to appear. That's not where the best deals are coming from. The best deals come from motivation, not listings. And here are some real sources. A, off-market sellers. These are homeowners who have not actively listed. They might be tired landlords, inherited property owners, people facing relocations, owner dealings with repairs. These sellers are more flexible on price and terms. B, distressed situations, not the property, the situation. For example, a divorce, a job loss, a tax delinquency, a vacancy issues, expired listings. Distress creates urgency. Urgency creates opportunity. And where do you see these homes? Not on MLS listing. You have to go to the court and scan through the list, the long list. That's where you'll find something in there that will make you think. That's the secret. I go often to the courthouse here in downtown. I scan through the list every month. If I see something, I will call a few investors that I work with and share that information with them. By the way, if you're a beginner or an investor and are looking for guidance on how to get started in real estate investing, feel free to book a 20-minute free phone call with me. Link below in the description. We can go over the numbers together and can come up with an actionable plan. C, expired MLS listings. These are gold mines. Why? Because the property did not sell. The seller is often frustrated. Competition has moved on. A simple follow-up here can uncover motivated sellers. Then you have D, the wholesalers. Wholesalers are deal finders. But be careful, some deals are good, some are heavily marked up. You still must analyze every deal yourself. Wholesalers are not out there to build your portfolio. They are there looking out for themselves. No one really cares about you more than you and your family, and that's the truth. I've learned in this business, people will stay friends with you as long as they're able to make money off you. Once you start controlling how much money you are drooling out to them, they will be the first people to jump ship. Section 3, how to analyze deals fast. Finding deals is one thing. Knowing if they're actually good is what matters. Let's simplify deal analysis. You only need 4 numbers. A, the purchase price. What are you paying for? B, the repair cost. Be realistic, not optimistic. A beginner mistake is underestimating repairs. Always add a buffer. C, after repair values. ARV. What will be the property sell for after it's fixed? Use some comps. Same area, similar size, recent sales, last 3 to 6 months. D, holding plus selling cost. People forget this and lose money. This should include your insurance, your taxes, your utilities, your realtor fee, the loan interest. Simple rule example. Let's say the purchase price is $150,000. Repairs are $50,000. ARV is $260,000. Cost is $20,000. Total cost is $220,000. Profit potential $40,000. That might work for a flip. But if your profit drops below your risk threshold, you walk away. Discipline beats excitement every time. Section 4, how do you spot hidden deals others miss? This is where experience really shows. Great deals are not always obvious. Here's what the beginners miss. A, look for ugly listings with good bones. Some houses look terrible online, bad photos, cluttered rooms, outdated interiors. Most buyers skip them. But under the surface, good structure, solid layout, strong neighborhood. Opportunity hides in presentation. B, look for days on the market, DOM. The longer a house sits, the more motivated the seller becomes. The more motivated the seller becomes, the more flexible pricing gets. Look for listings over 30 to 90 days. In fact, this is the first thing I check. Sometimes, even if a house is worth buying, I'll not put in a contract if I feel the house is not worth the purchase price. I will wait. Now, if the DOM is 30 days, well, now I'm eyeing it. C, look for price reductions. Multiple price drops signal sellers' frustration, weak demand, perception. This is our entry point, my dear investor friends. They have taken the first hit. It's time for you to swoop in and gobble the asset. D, look for rental inefficiency. This is a big one. Ask, is the rent below the market value? Is the property underutilized? Can you increase the income with simple upgrades? Small improvements can unlock major cash flow, and this is especially true for multifamily units. I made a video on the hidden deals that explain this point in more details. Check that out here. That's why if you're planning to invest money in real estate, go ahead and book that free 20-minute call with me. Link in the description below. We can look at your deal together. Section 5, the deal filter system. Successful investors don't analyze everything deeply. They filter fast. Here's a simple 3-step filter. Step 1, location filter. Does the area support your strategy? If not, you immediately reject it. For example, if you live in Miami or any other high tourist area, Airbnbs makes more sense, not buy and hold. Step 2, number filters. Does it meet your minimum returns? If not, adios, you reject it. Step 3, the risk filter. Ask, is the rehab uncertain? Is the seller unclear? Is the financing too much complicated? Uncertainty equals walking away. The rehab filter is really the biggest unknown. A hood that goes on top of an oven used to cost $37 in 2013. Today, the same thing costs $90. And the labor cost is changing almost daily. The war in Iran is causing too much stress. The gas prices are fluctuating. The contractors who work for me have started charging so much more. You ask them, boss, what happened? Why this big invoice? They will all blame external factors like gas and material cost. If you have a couple of homes, you can manage it. But once your portfolio starts growing, man, you need reliable people and hope that their rates don't change, because you cannot be at every place at the same time. This system prevents emotional decisions. Remember, you don't need more deals, you need better filters. I bought a project once. Oh my God, it was such a nightmare. There were no leaks in the basement, but you could smell the mold in the air. The tenant claimed that his kids are falling sick because of the mold, and I couldn't find the source of the mold. Some guy came along and told me that it's the window well that had fallen apart and the water is holding up there. Oh my God, it was such a pain to have that rectified, and it costed me so much. It was a risky investment house, one which I did not realize it and bought it. So if you need some guidance, go ahead and book that free call with me. Link in the description below. Section 6, how to find deals consistently. Consistency beats luck. Here's how investors stay consistent. Number 1, the daily deal sourcing habit. Every 30 to 60 minutes every day, MLS scanning, off-market outreach, wholesaler lists. Consistency compounds. Number 2, build a lead pipeline. Don't chase deals randomly. Track cold leads, warm leads, hot leads. Follow up where most deals are won. Number 3, build relationships. Deals come from people, agents, contractors, wholesalers, property managers. The more people trust you, the more deals come to you. Come to me. I live in Charlotte. I've been a broker here. I work with so many local investors. Number 4, act faster than others. Good deals don't last. Speed matters. Analyze quickly, decide quickly, submit offers quickly. You would be surprised how quickly good deals disappear. People say, oh, the interest rates are so high, homes are so expensive. But believe me, when the right price home comes into the market, it's gobbled up even before someone blinks. That's why if you have questions, doubts, concerns, go ahead and book that free 20-minute call with me. Finding the right real estate deals isn't about luck. It's about not having inside knowledge. It's about knowing what a good deal is, finding motivated sellers, analyzing deals, analyzing numbers properly every day, filtering out the bad ones, the bad opportunities fast, and staying consistent. Most investors fail not because they can't find deals, but because they don't know how to recognize the right ones when they see them. If you master this skill, everything else becomes easier. Financing, scaling, cash flow, wealth management, everything. Because in real estate, everything starts with the deal. I hope you enjoyed this video. Make sure to like it, subscribe it, and comment below what was the craziest way you found a great deal. And I will see you in the next video. So until next time, this is Vikram signing off. Good luck, goodbye, and go earn your freedom by finding deals that will make you millions of dollars in the future.